How is the tightness in repo market funding impacting liquidity and the Bitcoin price? Welcome back to the Bitcoin Layer. I'm Nik Bhatia, joined once again by the Bitcoin Layer research associate Demian Schott. Today, we are going to discuss the Bitcoin price, but more specifically, the repo market and how it is the driver of Bitcoin price, or whether it is at all. That's the topic of our discussion today. Before we get to that, I want to bring up the market real quick. We saw that Bitcoin took a big dip over the last 48 hours, trading below $100,000, has bounced back above. I want to note something very important that I saw looking through the candles this morning. One of the things that I look for in price action is divergence. This is a concept that combines price and a momentum indicator. What we're doing is we're looking at is the price making new highs with a lower momentum reading, or is the price making new lows with a higher momentum reading? These events are called divergence in the market, either a bearish divergence or a bullish divergence. They're very important market signals, and TBL pros who read along at thebitcoinlayer.com/subscribe are always alerted to these big divergences that I see in the market. But I saw one that is quite different from those that I've seen in the past, meaning that it was looking at the Bitcoin price not versus the momentum of that price via an indicator such as RSI. That's the one I commonly use. No, this is comparing the Bitcoin price with the Bitcoin to gold cross, which means the price of Bitcoin relative to the gold price. So we saw a new low made this week, but a higher low in the current downtrend of Bitcoin versus gold. So I just want to flag that for you guys. It's something that I'm going to be looking into, probably writing about later this week at the Bitcoin Layer. And with that, Demian, great to see you. What is your first question here?
So I want to ask you about the mechanics of how liquidity finds its way into Bitcoin, but I first want to ask you more of a forward-looking question about where we're going. So in the last three videos talking about repo, you've explained that the Fed has to increase reserves, and it's not to stimulate markets, but it's literally because the system can't clear payments, they can't fund Treasury issuance or maintain stable repo rates without them. So that's why it's like not QE. But I'm wondering, if the Treasury keeps issuing at this pace, so the Fed is forced to expand reserves just to keep the repo market stable, are we entering a world where the Fed just has to ignore its 2% inflation target to maintain liquidity?
That's a very good question. The Fed has two official mandates. Those are stable prices, meaning inflation targeting, and maximum employment, meaning low unemployment, or trying to avoid unemployment. Now, just looking at those two things, Demian, they serve or they counterbalance each other, meaning that a hot labor market, everyone has jobs, is going to cause hotter than expected inflation, or I should just say higher inflation. Because when you have people earning money, you have more aggregate demand, and that's going to push up prices in the short run. Pure economics 101. So by itself, the Fed has two mandates that they can't always nail down at the same time, right? Take the other side. Say inflation is too hot. What do you have to do mechanically to bring inflation back down? You have to cause people to get fired. So you trade one mandate for the other, and the Fed, at least from a PR perspective, has to balance these two things. Now, let's add in this third mandate that, let's just say, this is a long-standing joke in the market for the last 2 decades, that the unofficial third mandate of the Fed is the S&P 500. Now, going deeper into that, what we should really call it is that the Fed's third mandate is financial stability, which is what you're talking about. Calmness in repo markets, calmness in funding, no tightness, right? Everything functioning well. And we can see here, stocks and Bitcoin drawing back a little bit. I'm not really quick to say, hey, this is a repo tightness caused spill in the risk market. I know we're going to talk about that a little bit today, whether that's the case, whether it's directly causing it or not. But let's set that aside. I don't really think that it's tightness in repo market that's causing the stock market to go down. But the fact that these things happen causes the Fed to wake up. Just like we said, repo is only fun to teach when there's something happening in repo, because when there's nothing happening in repo, it's just inside the corridor, right? We can throw up our corridor chart for people and they can just see that, yeah, for sometimes years at a time, there's nothing to talk about in the repo market because it's just repo rates within the Fed's floor and ceiling. So their markets are functioning as they see fit. But then now markets are not trading inside the corridor, where they're showing a lot of examples of trading outside the corridor. It means that the Fed has to wake up and do something. So that's why you get the end of QT. You'll get this not QE announcement within the next few months that this is how we're going to increase reserves and the quantity that we're going to do. We're going to buy T-bills, all of that announcement. Now, to go back to your question, are they just abandoning the 2% inflation target? It's not that. It's that they have 3 mandates and they have to balance them. So right now, inflation literally does not matter to the Fed. The reason is that repo markets are tight and unemployment is starting to wake up. So 2 of their 3 mandates are flashing red. And I wouldn't say that the labor market is flashing red. It's definite. The light is on there. So they have to pay attention to these mandates. And so the answer to your question, the short answer is that it's not that they're abandoning it, Damian. It's that they have to pause, just like when inflation got to 9% in 2021, 2022. There's nothing that the Fed needs to worry about on the financial stability front. They have to address inflation, so they have to get rates to 5.5%, and you saw them do that, even though 2022 was a big bear market for the stock market. And we know what happened in 2022 with Bitcoin, with a massive down move. Stocks were down double digits in 2022, and the Fed, we weren't running that joke about, oh, the Fed's third mandate is the S&P 500. They're going to come in with rate cuts and QE. They didn't do any of that. In fact, it was the exact opposite. So we have to step back from the 3 mandates, the 2 official ones, and the third unofficial, which is financial stability / the S&P 500. But it's not really the S&P. It's funding markets, it's repo, and it's the Treasury market stability, because the repo market is a derivative of Treasuries, right? When I thought Augustine's social media post this week was brilliant, where he talked about how repo markets might calm down if the Fed starts, or if the Treasury starts spending down money that sends money back into the system, but also if T-bill quantity reduces. It just means there's less treasuries to fund and funding becomes easier. So the amount of collateral goes down. Now, if the amount of collateral goes down in the system, everything smooths out. So what I'm trying to say here about this specific thing is that the Treasury issuance, if it gets out of hand or gets ahead of its skis, will cause the Fed to react, right? That's the fiscal dominance concept that actually the T-bill issuance schedule is in the driver's seat. So how can they think about 2% inflation in a time where they're having to juggle the Treasury Department moving around $1 trillion here and there in the system? Withdraw, put it back in, issue a bunch of bills, borrow and spend. That's a lie. That's a live ball, as they say, or that's the hot potato. They have to pay attention to that. And then, inflation is over here. They can't look at it. And I bring up 9% CPI, the last thing here. I bring up 9% CPI because right now it's at 2.8, 2.7, 2.9. So that's why it's just out of sight, out of mind.
Mhm. But the government is still issuing more and more T-bills, and it doesn't look like it's going to slow down. So I'm just asking, like, are we entering like a new world where the Fed is just going to have to permanently adjust its inflation expectations?
Yes, but what we have to remember is that with inflation today at under 3, it's close to 2. So it's close to where they want it. If this conversation is being had between you and me, Damian, and CPI is at 4.3%, that's double their goal, right? That's starting to stray. Then you and I are having a conversation about that, and we're also looking at what Besant and Trump are saying about the fact that they have not tamed inflation. Actually, inflation is too hot. So your question, which was, well, if they keep doing this bill thing, more and more T bills, and then forcing the Fed to grow the balance sheet, won't that cause inflation and all of that? If you look at what they're saying, meaning Besant, he's touting that the deficit to GDP is going down from 6% to less than 6%. He's touting that inflation is staying below 3%. So they are politically hitched to stable inflation. So if it got to 4 or 4.3 or 4.5%, you and I would be having a different conversation. So I can't get to speculate there because what they're doing right now isn't causing 4% inflation. It's causing 2.8% inflation. And that's a huge gap. Tariffs are going to, at the margin, increase the purchase price for consumers in certain products, but they are not money creation. So from a monetary inflation perspective, they just move around who's getting the money. And who's getting the money, Damian? The US government is actually collecting a lot of that tariff revenue. Let's say a Chinese exporter now is facing tariffs. They double the price for the American. They keep their profit margin. So the Chinese unaffected, the American suffers in this one example I'm giving. So the American pays more and it goes to the US government, right? Or the US person doesn't pay anymore because the Chinese exporter eats the tariff. So the Chinese exporter gets less margin, less profit. Who gets the profit margin? The US government gets it. So it's non-inflationary from a monetary perspective. That's important. So I love your question, but we have to look at what are the things that are being affected right now, and we're going to watch the T-bill issuance. Here's another thing: the government has all this money because they can't spend it because the the resolution hasn't passed. When that gets passed, they don't have to issue bills for a while because they have $1 trillion sitting in the TGA that they can just spend down. I know they want it somewhere in the, I think they said they want it around 700 billion. You'll have to fact check me on that, where they want the TGA targeted. I think they wanted it around half to $750 billion. So they're definitely above that. They're definitely issuing more bills, building it up, but at a certain point that'll reverse, come back down. That money will enter back into the repo market. That's what Augustine was saying, that there'll be some relief because there'll just be more reserves. Why? Remember, TGA and reserves are a zero-sum game. So as the government spends down, TGA reserves mathematically increase. That will relieve some pressure from the repo market, and on we go. All right, I want to let you guys know about another great Unchained event that is taking place online October 28th with Mark Moss and Jeff Andrew. They will explain to you why the 401k system is not meant to serve you, but meant to serve an entire fee structure. And they will teach you why Bitcoin scarcity make it the perfect asset for a retirement portfolio, and some of the regulations around Bitcoin in retirement and how you can get that Bitcoin into some of these tax-advantaged retirement portfolios. Register now at unchained.com/TBL. Never sell, just borrow with Arch Lending. Arch lets you borrow against your Bitcoin, unlock cash without selling, instantly access a Bitcoin-backed line of credit for as little as $5,000 for up to 2 years. There's no rehypothecation ever, and insured custody at Anchorage Digital. Stay long, stay liquid. Go to archLending.com/TBL and use code NIK, that's NIK, for 0.5% off of your interest rate.
So I want to bring this all to Bitcoin now, because a lot of what we do is understand how much liquidity there is now, how much liquidity it looks like there's going to be. And you describe Bitcoin as a measure of liquidity. Why do you describe it as that?
Yes, the tough thing about the word liquidity is how many different ways it's used, and even we use it. It does make it challenging. So we're going to continue to teach it in the best way that we can. When I say that Bitcoin is a liquidity asset, what I mean is that it's not a fear asset. Okay? If it was a safe haven, this is the term that's used for gold. If it was a safe haven asset, and for many people, Bitcoin is a safe haven. For me, I would categorize it as that. But for the broad world, Bitcoin is not a safe haven asset. It doesn't act like that mechanically either. It's a safe haven for people that understand what they get safety from with Bitcoin. So let's give a special shout out to all of those out there that view Bitcoin as a safe haven asset, because beauty is in the eye of the beholder. I believe that. And a safe haven asset is also in the eye of the beholder, or the hodler in this case. But it's not a safe haven asset in the global market. It is a liquidity asset, which means that Bitcoin goes up and down as money enters and exits the system. So liquidity in this sense means the flow of money. We've talked about liquidity as flow, nonstop. And when we think about TBL liquidity and the conditions for credit creation, what we're talking about is conditions are good for more money to be created. That's liquidity. Conditions are bad, so money is being sucked out of the system. And Bitcoin responds to that. If, let's say, we had a lot of conflict in the Middle East, we had bombs going off this year. There was a lot of geopolitical conflict. We still have a Russia-Ukraine war going on. in a battle between NATO and Russia, it's contributed to gold, or we could argue that gold has traded well in global chaos and found a safe haven bid. Bitcoin isn't popping by 6% when Israel fires the missiles to eastward. Those are the signs of what drives the market. It's not really a geopolitically driven asset from the price perspective. You and I love to analyze geopolitics and how it supports the Bitcoin thesis medium to long term. And we do a lot of that analysis because we view it as important. But when we look at Bitcoin go down this week and last week, and the dollar go up last week and this week, what we're doing is we're saying Bitcoin responds to conditions for the flow of money. What happens, Damian, when the US government stops paying its employees, which currently we're in a zone where some people are not receiving paychecks? What
Well, they
happens
don't.
at the margin? What's that?
Well, they don't have money to spend. They don't deposit money. The banks can't use those deposits.
That's right. It's staying in the TGA. But you have to remember that when the flow of money comes back, and you think about the average government worker, percentage of it goes to tax withholding, so it goes right back to the government. Percentage of it goes to their living expenses, so circulating in the US economy, and then some of it goes into financial assets, which today includes a sliver of Bitcoin. So if you think about $100 pie chart, 90 of it goes to taxes and living expenses, 5% of it goes in a rainy day fund, and 5% of it finds its way back into the stock market. And of that 5% that finds its way back into the stock market in the year 2025, on the aggregate for the average American, there's a slice of that $5 that's actually making its way into Bitcoin. So let's say $1 into Bitcoin, $4 into stocks. It's probably much higher on the stocks to Bitcoin ratio than that 4-to-1 that I just said in the example. But out of $100 the government spends, five of it used to go into the S&P 500. Now 4 of it's going into the S&P 500 and $1 of it's going to Bitcoin. Now don't quote me on the percentages. That's not the point. It's the concept of flow. We talk about your questions about liquidity. So I'm answering that from a flow perspective. If you shut it off, you shut part of the buy flow for Bitcoin off. The government being shut down is one example, but when the dollar goes up, and the dollar has charged here. I mean, I know it's only up about 4%. That's a big move in currencies. It creates tightness in global liquidity. There's less ability to create that new credit, which some of it ends back up in financial assets all the time.
But so I'm wondering, do traders front run the news when it's going on? Because when repo spreads are widening or like the dollar is popping, Bitcoin seems to react like right away. But I can't imagine right away there's a change in the amount of money that's available. Is it people looking at that and the market understands that that's a driver of Bitcoin, so therefore they're trying to sell the news type of thing? Or is it legitimately there's less money just quickly that's available to flow into the asset?
That's an excellent question. So one of the things that we've been researching is this coincident indicator of liquidity affecting markets today, same day, like interest rates spike, volatility spikes, Bitcoin down today. This all happened. We're watching that, but we're also developing an indicator to try to get 6 months looking in the rear view on liquidity for what is going to happen today in Bitcoin. So I don't have a great answer to your question because there's no way to know exactly. I think it's a little bit of both. But let me tell you the first order of effect, okay? Which is that if you see a pop in repo spreads, what you're seeing is a little bit of tightness in cash. That cash that is being withheld from the repo market makes its way down the line into other types of margin funding. So leverage Bitcoin positions, but also volatility, which affects options pricing and all that. It all becomes a little bit more expensive. So if you want to take a leverage position in Bitcoin, your margin broker might allow you a 50-to-1 leverage, but things are a little bit tight over here on the repo desks. So we're going to change your leverage maximum from 50-to-1 to 20-to-1. And what if you're leverage long and you don't have the margin? You have to auto sell. So leverage liquidations and tightness in funding are where to watch that relationship. So if you're going to watch something, you would watch open interest and funding rates for Bitcoin and how those react to spikes in funding. So we'll look into the numbers and we'll look, okay, there's a spike in funding last week and this week. Did that cause long liquidations in Bitcoin? Did open interest decline, meaning the number of futures contracts just went down because longs got liquidated and shorts collected and closed the trade? Open interest goes down as those liquidations happen. And then funding rates, were funding rates elevated? Did they go negative? Those are some of the things that we would try to watch to find that relationship. The short answer again to your question is that I it's impossible to know if it was a spike in funding causing long liquidations, causing the Bitcoin price to go down today, or are these lagged effects from tightness and liquidity 1 month, 3 months, 6 months ago that are now trickling their way into risk? You see stocks and Bitcoin going down at the same time this week. Are those the effects? That's a $2 trillion question and something that we'll continue to study.
So historically, has Bitcoin lined up with periods of rising liquidity? So what I'm trying to get at is it seems like Bitcoin has these regular 4-year cycles. And then the big cycle in 2021, the Fed was also unleashing a lot of liquidity, and it's the same time that Bitcoin was going up. And now we're near the end of that historical cycle, but now QT is ending and the Fed is going to start unleashing liquidity into 2026. So in your opinion, do you think there's going to be a change on um, how Bitcoin's going to react now in this next year versus how it should react historically? Are we looking at a bear market coming like it should, or are we still going to see movement up?
What I want to do is step away from if the Fed is going to be a driver of the Bitcoin price. That's where my mindset is. Go back to my example of $100 pie chart, that getting spent and some of it ending up in Bitcoin. What I'm actually saying, if you read between the lines, is that if the global economy is doing well, expanding, credits being issued, and volatility is low, Bitcoin should do very well. The Fed is not in that conversation. The Fed being there to support, and this goes back to your first question, the Fed being in there, expanding its balance sheet to support the bill market and repo market functioning in the absence of 4% inflation, meaning they do it, but it doesn't goose inflation to 4. That's very good, because what happens, Damian, to the move index when inflation is calm? What happens to bond vol?
It'd be going down.
which means calmness. So if inflation isn't kicking up because of all the things that the government is doing, plus the Fed assisting, right? The Fed is the alley-oop to the government. The government spends and the Fed just says, okay, like here you go. Here's a little bit more balance sheet from us. Keep doing what you're doing. If the end result is CPI at 2.9%, essentially everyone wins except the segment of the economy that isn't able to get their average hourly earnings above 2.9%. So do your best, and I know this might be difficult, but do your best to remove the Fed from the drivers of Bitcoin price and the drivers of liquidity. It's actually the economy and the balance between growth and inflation. If real growth is good, but inflation isn't raging, bond volatility stays calm, Bitcoin does well. Yes, the Fed is there to maybe help. If the Fed is not there, Damian, if the Fed doesn't end QT last week, you get a funding market crisis, you get something in banking, you get a default, you get contraction, you get a big spill in the stock market, and then politically the US government is at risk, and what do? They just run to bailout. And that's the cycle that we're used to. That's the cycle that we have to think about, that the government will and the Fed will try to get ahead of any bailout situation, and therefore try to keep the repo markets calm and try to support things. That's where I would be thinking about what the Fed is going to cause or not cause on Bitcoin. So I know I didn't exactly answer, so I'll let you ask a follow-up there.
Yeah, well, just to clarify, so as Bitcoiners, we don't need to look exactly at these 4-year cycles. We just need to look and ask, is the amount of credit creation in the market healthy, and is inflation not spiking up? And if those two things are true, then it means that Bitcoin should be doing well regardless.
Absolutely. And it's going to be a balance. You have to see that, yeah, credit creation is going great. Well, that is monetary inflation. And that will trickle down into price inflation, at the very minimum, asset price inflation. And does that inflation then cause people to want to sell bonds because the interest rate isn't high enough to compensate for future inflation? Then there's a balance that has to be struck, and then Bitcoin can be jeopardized. Remember, the CARES Act bottom, Bitcoin went from 3,000 to 70,000 on the government spending a ton of money. But it caught up with the bond market, because the bond market said, oh my God, I'm going to get 1% on my 10-year Treasury. I need to sell that thing right now. And the guy at 150 sold it. The guy at 2 sold it. They sold it at 3. They sold it at 4, all the way up. Mass liquidation and another 80% Bitcoin bear market. So we have to think about what caused previous bear markets. 2017, there is an argument that it was just one giant long liquidation and an actual frenzied bubble that got out of control. The COVID bottom at 3, remember the 2017, you get to 20K, and then it went to 3, 2019, and then again in 2020, in February, March, it went to 3,000. That bottom at 3, if you say, oh, it's because the Fed did QE infinity, You're missing the point. It's the flow of real money into people's accounts that allows them to spend and buy stuff and drive prices up, not the Fed printing money. Remember, the Fed is just the alley-oop. It's just the assist. That, and for this, I think the second time in 2 episodes, here's a Lynn Alden shout out. That is the concept of fiscal dominance that Lynn told us to look at more closely in 2023, 22, 23. That look at the influence. It's not the Fed. And if it was, then and this is what we've talked about. If it was, then we have some explaining to do for the 1% CPI level we had all of 2010s, basically, where inflation was 1.4, 1.6, 1.7. It couldn't even get to 2. They couldn't even get it there. So, and that's with 3 QE programs over 7-8 years. All right, Damian, great questions. We're at $103,000 on Bitcoin. After falling below 100, we'll have to continue to watch the price very closely. That potential bullish divergence with Bitcoin's price and the Bitcoin to gold cross. Repo rates today came down, much calmer, and we'll continue to monitor SOFR versus the Fed's corridor going forward. With Damian Schott, I'm Nik Bhatia, the Bitcoin Layer. We'll catch you guys next time.